This isn't just another inflation report. This is the first number in over a year that could actually change the direction of stocks, crypto, and Fed policy all at once. You know, in the world of investing, it's kind of wild how a single decimal point can shift entire markets, right? It can literally change fortunes. Well, today, we're going to zero in on one of those numbers, a figure that has the power to shake up Fed policy, move global stocks, and send a really critical signal for crypto. And here it is, 2.7%. That's the one. This single number is what everyone on Wall Street is talking about, and for a really good reason. I mean, on the surface, it looks kind of quiet, but believe me, what it means for every single investor out there is incredibly loud. All right, so let's dive right in. We're going to get under the hood of this number and really show you how all the gears turn. We're going to trace its path from just a piece of economic data to what the Fed does next, and all the way down to how it could impact your portfolio. So to get the full picture, we're going to move through 6 key areas. First up, just the hard facts, what this inflation drop is all about. Then what it means for the Fed. From there, we'll look at the chain reaction in stocks and a signal for crypto. After that, we need a little dose of reality before we tackle the big one. Are we looking at the start of a whole new cycle? Okay, first things first, let's just establish the baseline here. No spin, no speculation. What exactly just happened? So the number we're talking about is for Core PCE inflation. Now, if you're not familiar, that's basically the Federal Reserve's favorite inflation gauge. They watch it super closely because it strips out the wild swings you get from food and energy prices. It gives them a much clearer signal of what's really going on. And at 2.7%, well, that's a pretty significant drop. It's actually the first time in over a year that we've seen this key metric dip this low. Okay, so a number came out. Big deal, right? Well, yeah, it is, because now we have to ask the most important question for the markets. What is the Federal Reserve going to do now? And here's the absolute core of it. For months, the Fed has been keeping interest rates high, in this all-out fight against inflation. This 2.7% number, it finally gives them some breathing room. It dials back the pressure to keep things so tight. And for investors, this is the signal they've been waiting for. It could be the starting gun for a real market rally. Now, this is a really important distinction we have to make. There's a big difference between inflation falling and inflation being at the target. Think of it like a road trip. This report basically confirms we're on the right highway and heading in the right direction, which is fantastic news, but we haven't reached our destination, that 2% target, just yet. And that little nuance is everything when it comes to figuring out the Fed's timing. So the next logical question is, how does this potential shift from the Fed actually hit the stock market? Well, it's not magic. It's actually a pretty clear mechanical chain reaction. It pretty much works like this. Step 1, the market sees that 2.7% number and immediately starts thinking, okay, rate cuts are coming. Step 2, the bond market, which is always trying to get ahead, anticipates this. Traders start buying up bonds, and that pushes bond yields down. And step 3, this is the real key for stocks. Just think of it like this. Lower bond yields are kind of like putting the future on sale. All those profits a company hopes to make years from now, they suddenly become way more valuable today. And that gives a nice valuation boost to the whole market, but especially to those growth and tech stocks whose value is tied up in future earnings. And, history can actually give us a potential blueprint here. A lot of people point to the cycle back in 1995 as being a really close parallel to today. And what's interesting is that in the 6 months after the first rate cut back then, it wasn't just tech that took off. Actually, a lot of defensive sectors like healthcare, telecoms, consumer staples, and utilities, they all outperformed. It's a great reminder that the benefits can be really broad-based. All right, so we've talked about stocks. Now let's switch gears and look at the world of digital assets. Yeah, let's talk crypto, where the impact of this inflation data can be even more dramatic. So you might be asking yourself, why does crypto always seem to react so fast to this stuff? I mean, it often moves before the policy changes even happen, not just after. What's going on there? Well, here are the core drivers. At its heart, crypto is all about liquidity. It thrives when there's more money flowing through the financial system. So when you see lower inflation, that points to future rate cuts, which in turn means easier money. And when money is easier to come by, investors' appetite for risk goes way up. And what's at the far end of that risk spectrum? Yep, assets like crypto. They often become a primary beneficiary of that new confidence. So the key takeaway here is that this 2.7% number is a really powerful signal for the crypto market. It's a huge sign that the tide on liquidity might finally be turning. But, and this is a big but, it's not a guarantee. You have to remember, this market is always looking ahead, and it's treating this data as just one single piece of a much, much larger puzzle. Okay, I know. The picture we've painted so far sounds pretty optimistic, right? But before we all get carried away, it is absolutely time for a crucial reality check. Let's pump the brakes for a second. This is where we separate a promising signal from, just irrational hype. Let's just look at the numbers again, plain and simple. We are at 2.7%. The Federal Reserve's goal is 2.0%. See the gap? Progress is not victory. There is still ground to cover, and trust me, the journey from here to there probably isn't going to be a straight line. So what this really means is that while this one data point is definitely promising, it's just a single frame in a much longer economic movie. It's a hint, it's not a confirmation. If you're thinking this one number single-handedly kicks off a new bull run, you're getting way ahead of the story. And we really can't forget, there are some pretty big structural headwinds still out there. I mean, global supply chains are still a bit of a mess, and that can add costs. You've got large government deficits pumping money into the economy, which can be inflationary, and we still have major shortages in key areas like housing and labor. But maybe the most important thing is that our psychology has shifted. We, consumers and businesses, now kind of expect higher prices, and that can become a dangerous self-fulfilling prophecy. One good inflation report just can't erase all of those forces overnight. Alright, so let's put all these pieces together. Let's try to answer the one big question that's on pretty much every investor's mind right now. So what does this all really add up to? Is this 2.7% number the actual starting gun for the next bull run? Or is it just a little blip in a market that's going nowhere? Or is it something a bit more subtle? The first really credible hint that we're at a major turning point? I think this quote just frames our current moment perfectly. We really are on a new frontier. On one hand, you've got all this promise from the data and the idea of lower inflation. But on the other, you've got all this pressure from those structural risks we just talked about. The market right now is completely defined by that tension. So what's the bottom line? Look, this 2.7% number is way more than just noise. It's a powerful signal that the tide might be turning, but it's absolutely not a guarantee. It does point toward a future Fed policy shift that's good for both stocks and crypto. But the road ahead, it's probably going to be bumpy because of those risks we mentioned. So no, this isn't the confirmed starting whistle for a brand new bull market, but it is the strongest, most data-driven signal we've had yet. For the first time in a while, there's a very real reason for investors to feel optimistic. And this is exactly the kind of signal we love to focus on here, separating the real data from all the drama. So if you want to stay ahead of the curve and get calm, analytical breakdowns of the signals that actually matter, make sure you subscribe. Thanks for joining us for this explainer.